You can't be emotional about real estate. You can't be emotional about investments. And the key is,
what is a healthy success rate when you are dealing with offers?
what people aren't understanding is real estate markets are cyclical and the only inevitable thing is change. And what's changing is the house prices have gone like that and the unit prices.
Thank you very much for coming on the podcast. Really appreciate it, Tim. Tim, for our listeners that don't know about you, who are you and what do you do?
Well, it's a big one. I'm Tim Graham, General Manager of Hotspotting, also the host of the Property Playbook TV show on Ticker. And basically I've been a buyer's agent, real estate analyst for probably 11 years. And obviously representing Hotspotting here today.
Nice, fantastic. We came across you obviously through Hotspotting. We use the platform. We love it. We're advocates for it. And I think a lot of the data that we sort of pressure test is with Hotspotting, which is fantastic. And of course, we ended up meeting you and amongst all the other great things, the boxing, fanatics that we love, the many things that we sort of connected on, boxing being one of them. It was really good to see that, you were open for a conversation and you had a wealth of knowledge in terms of whether it was buyers advocacy, previous businesses that you managed, and now, of course, Hotspotting that is taking the buyers agency world by storm and helping us in terms of, making smarter decisions.
That's
so
terrific.
Thank you very much for that.
Very complimentary. Thank you.
No, that's all right. Full of compliments always. So today I think we're going to cover off is a little bit about, property, buying while buying at the right time. There are three really important things when it comes to negotiating and buying property. What are they and why they help us so much?
Yeah, I think it's a good point. I think most people think, going out and buying a piece of real estate is as easy as looking on realestate.com and saying, I like that one. And you go in and say, this is what I'm prepared to pay for it. But there's so many things about winning a deal that people don't realise. And obviously, when you go and negotiate for a piece of real estate, the obvious one is price. Right? And the other one that some people don't know about is the terms. Do I have a finance clause? Do I need to have conditions like I'll buy this if I sell that? There's lots of little terms that can really throw your deal out of the water. So the less conditions you're going to have, the better it's going to be in terms of a vendor wanting to accept it because you're making their life easy. And also the agents for that matter.
Yeah.
The third one, which is a little less known one, is the timing of your offer. So depending on where you're buying, some markets might be a little bit slow and they've got days on market, 30 to 60 days. It's probably less competitive there. But on these frenetic markets where it's really frantic, and you might have a listing that comes up today and you go, I'd love that one. So then a lot of people are jumping in straight away and they're going, I'm going to put an offer in today. The challenge with that is if they haven't had an open, they're not going to accept it.
Yeah.
So what's happening is they're just going to leverage your offer to carry into the weekend and leverage a higher deal. So timing's super important when it comes to placing your offer. So the way that I would go about it most of the time is if they, let's say it's early in the week and we know that they've got an inspection on Saturday, feel out where the offers are at. If they have any at this point when you're looking to close, are you going to proceed with that open for inspection? And if they are, I just stay in contact with them straight after the open for inspection. Where are things at? Do you have any offers? And then there's little questions you can ask to find out where the offers are at. They might not tell you the offer is 560, which they're not supposed to, but you might say, does it have a 5 in front of it? Or does it have a 6 in front of it? Because I want to place an offer that's going to be competitive. So other questions that I might ask at that time is I say, look, I've got an offer I'd like to put forward. It's about 560,000, and I might have a little bit up my sleeve when I say that, 560,000, 7-day building and pest. We've got no finance clause because I know that we can go higher than the budget that we're in. And I'll say, would that be competitive? And that's where the vendor a lot of the time, the vendor or the listing agent, will often give you, some hints. Look, you're a bit off the mark. You've got to raise it. Look, that'd be competitive. Formalise it. And at least we're starting to feel out exactly where we're at. But I want to make sure that the timing of that means that we're about to go to the vendor and I'm, top of the pack or near enough to in terms of my terms and the fact that I've actually got at the end of the sales campaign instead of the start.
And I think a very important thing to note as well, like when you are negotiating and putting in your offer based on the timing, is gauging that agent from the get-go, having that rapport building session with him where you're asking them, him or her, how's your day been? well, how's the market been? What's this property's interest been like?
Yeah.
You know, building that relationship really does make things easier when you do ask those hard questions of, you know, what does it look like the offers are sitting at around right now? Because at the end of the day, you don't only want to put an offer in and try to negotiate hard from the get-go and play this game and song and dance when you've got no negotiation you've got no basis.
Yeah, that's right.
It makes things very, very difficult.
The other thing that you've got to understand as well is that we don't get an opportunity to speak to the vendor. The advice on whether or not to take that offer or that offer is coming from the listing agent most of the time. And the listing agent wants to sell it once.
That's right.
And if you know that, and that, what I mean by, for the listeners at home that might not understand what I mean, when selling it once means if I've got all of these conditions on the sale, like finance clauses and, a clause that I must sell this property before I can settle on that property, it's not a great offer. And what happens is inevitably it probably comes back on the market. The agent's got to have that awful conversation with the vendor again. Sorry, we're back to market. It's now on page 16 of realestate.com. There's no attention. Now we're going to drop price. So you got to remember that the agent wants to sell it once. Best way to get that across is to say to the agent, listen, if I'm neck and neck with another offer, sell it to me and you'll sell it once.
Absolutely.
If you fill the agent with confidence that you're buyer ready, like I've got my finance in place, I know that the only reason I'm not going to proceed on the building and pest if it's structural or something significant where we're not expecting it to be perfect. If you fill the agent with confidence, they'll take your offer.
Absolutely.
Assuming that everything else is
of course.
on par, okay? But it's important because you're as much selling the agent as they are to the vendor themselves.
Well, we're basically trying to fight for their attention, right?
Of course.
When they're dealing with a number of other buyers on the mix.
Yeah, or a lot of other buyers' agents that might be lacking experience as well, and they've been mucked about by these people in the past.
Absolutely. So getting the agent to focus on your offer is going to be absolute key.
Absolutely.
And how
Give them confidence.
Exactly. And how that's differentiated. Another thing that we like to also apply, and it's been working very well with us, is basically getting the agent to do some of the legwork in terms of what are some of the things that we should be thinking of and putting forward as part of the offer.
What's important to the vendor.
Exactly. Such as like a leaseback as an example, and being receptive around how we can position the offer to basically position it to the vendor as well. That works as key.
Absolutely.
I've got a question for you though, and something that Omar and I always talk about in terms of what is a healthy success rate when you are dealing with offers? So how much should we be winning? Because it is truly an art, right? You don't want to win everything because it means you're overpaying, and you don't want to win none because it means you're not being realistic in the market.
Look, it's hard to put that to a percentage. I would say that I win more than I lose, but it's because the ones that I would typically lose, I wouldn't be bidding on, if that makes sense. So by the time I decided that we're going to bid, it's because I think we're going to be competitive. But I would always recommend when you do your due diligence on a property, you want to figure out the top price that you're going to pay before you find out other offers, right? Everyone knows the stories of going to an auction and it's like, maybe 10 more or 10 more or 10 more. And then you lose by 10 grand and you go, if I just went 10 more, I would have won it. And you go, not really, because they would have gone 10, 10 and 10. It keeps on going.
Correct.
Yeah. So that same, philosophy or that emotion doesn't really happen when you take it away from the auction environment, but you should take the same mentality into your offer strategy when you're bidding on something that's on a normal, sales listing. And you say, this is what this property is worth to me, and I'm not going past it. And then you want to start to place your offers around, just below that, so that if you need to edge up, you're still landing there. Anything above that, we walk away from because we've realized that's true value to us. Anything else, let them have it. So I must admit, I don't lose a lot of them if I'm doing all of my due diligence, not only on the property to know that I'm bidding at the right price, but also I've done the due diligence on what's going to motivate the buyer, the vendor, and I've made it really clear to the agent that if they sell via me, it's going to settle much smoother.
Absolutely. What we're seeing with a lot of these very competitive markets is that agents aren't also necessarily going for the highest offer as well, because they're actually fearing that the bank valuation will come back as a bounce. And that's been also a considerable issue as well. So that whole notion around selling it once and having an understanding in terms of what the true value of a given property is based on your articulated due diligence is key as well.
If you're having valuation troubles on a free and open market, it means you're overpaying. Really does. I mean, look, realistically, you shouldn't be having valuation challenges on established properties if it's got comparables. Simple as that. Yeah. So if a bank says, no, we see that as high risk, I mean, I'd be walking away from it anyway.
Yeah, very good.
Like they're doing
Exactly
the due diligence and they say it's not worth it. Now, it's a bit different when you're looking at new build versus established and they don't have comparables and things. And obviously the price to construct is very, very different to what it was even 3 years ago. So I can understand valuation challenges in that. But on a free and open market, I mean, who's to say it's not worth that if everybody's bidding and they're all prepared to do it? If it's higher, as in you're bidding higher and bank comes back and said it's actually too high, then that just tells me that the market's overheated.
Yeah, exactly right. And there are so many of these markets.
You mentioned red flags before.
Yeah.
That's a red flag.
That's a big fat red flag.
That's a huge red flag.
Yeah.
That's exactly right. We should have had that in there. That would have been a good one.
Yeah.
Absolutely. There are so many hot markets right now where people are overpaying. I mean, the listing price is, let's just say 500 to 550. People are paying 620, 630, upwards of 650. Like it's absolutely insane and ludicrous to be in a market like that and think that they're walking in with value. It's very tough.
I've got a story that sort of relates to that actually, and it's a time when I've overpaid, which you might think is a ridiculous thing for me to be saying. But and ironically, I hope my wife doesn't watch this podcast. But
Here we go.
We'll cut it out.
The property's in her name. When we bought a property in Adelaide in a suburb of Blakeview in the Playford LGA, which is in the north. And, the northern parts of Adelaide, especially, through sort of Elizabeth area, there's 8 suburbs in that Salisbury LGA that start with Elizabeth Downs, etc. And that sort of market's always been a down market location. And, it's actually one of the best performing locations in Australia, ironically, over the last few years, which goes to show that you don't have to buy in, high socioeconomic locations to make growth.
Yeah, absolutely.
In fact, it's quite the opposite in a lot of ways. But just above that is the LGA called City of Playford. And I bought my wife, I helped my wife buy a property in Blakeview. And this went against the odds of anything that I've usually bought. It was 315 metre square block, right? Small block of land. It was a 3-bedroom, 2-bathroom, but it was directly opposite a school. It was 200 metres to a Woolworths. We paid $445 for this property. This is 2020, I want to say 2022, I think it was, but it'd be worth $700 now. And the rents have gone through the roof. Now, the reason I'm telling you this story though is I might have paid $449 for it, but we probably had it valued about $420. The reason I was confident to overpay, which no one wants to overpay, but the market was saying that that's what it was worth. And I thought it was worth a bit less than I paid, but I was that confident in the growth of the market that I'm like, $15,000, $20,000 today versus a couple of $100,000, I'll pay that to get in.
Yeah.
Now, I wouldn't recommend that strategy to everybody, but with my experience and my confidence in the market, I was prepared to pay that because I thought the location of the property, the condition of the property, vicinity to all the amenities that you're looking for. And let's face it, it was $440,000. It was getting $449, and we were getting $430 a week rent back then. And I think we're probably sitting about $520 a week rent now on a 700 val or something. So,
outstanding.
But that's an example of overpaying in some markets. You've got to be really confident that if you're going to pay a premium for the product, that it's got depth in terms of growth cycles.
So let's unpick that as well, because what gave you that unwavering confidence with that market?
So one of the proprietary formulas that we use at Hotspotting is called our price predictor index. And it's a really simple premise. If we see sales activity rising, which is the number of sales turning over in an area in a quarter, rising every quarter for 3 quarters in a row, it shows that there's demand. What tends to happen is sales activity responds first and then prices react later. So simple premise, demand going up, prices react. On the flip side of that, if we see sales activity declining, which is what we've been seeing in Perth for some time now, that's why we were raising the alarm bells probably up to 12 months ago to cool off on Perth, because we could see markets that were having 300-400 sales in a quarter, we're now doing 60. Right? So that shows that it's reached a peak and it can't go any further. So as a price predictor methodology, and this is before I worked at Hotspotting, but I was a Hotspotting member and customer for many years, and I could see like it was just spiking. And Adelaide's now had 5 really bumpy years of growth. So, and it can't just be sales activity. Don't get me wrong. There's a lot more depth. It's days on market restricting, rental growth going up, vacancy rates constricting. There's a lot that goes into it before you would just say, hey, let's buy here. But, it had a really big infrastructure boom going on there, electrified train tracks, lots of job creation, close to the RAF base, ticked all the boxes. So I'm like, if it's going to cost me a $15,000 premium to get into that market, but I'm really confident in it, I'll do that.
Yeah.
But I wouldn't recommend that strategy
No,
for
of
everybody.
course
No, of course
And
not.
nobody wants to overpay for anything. So I understand.
I had a very similar situation. I actually bought a property in Faulkner maybe about 4 months ago now.
Yeah.
And it was the same sort of, I went to an auction. It was, obviously buy as is, not going in there with anything else. Basically had a head-to-head with one other bidder that was a family, and they were increasing. And even though it went outside of my finance capabilities, I still went a little bit further. Although it would take away from my margins, I still wanted to get in because I knew it was in a cooling off
If
market.
you see future upside too.
And there was a lot of future upside. And that same property right now today is probably worth about 840, 850 in a short number of months. And there's only been 4 months since I bought it. So there is a lot of growth in certain pockets, and you can tell the auctions that you go to, the anecdotal evidence that you give.
Yeah, that's the word.
That's a very important factor that a lot of people don't take into consideration also. And we've seen it time and time again where, these areas are growing. The data might show it, but there's obviously a delay in data too. So there is that anecdotal evidence that you have to put into play to give you that insight.
absolutely.
I think you're right. But the buyer beware part is you can't let emotion be the one that's driving that decision.
right.
You really need to make sure that, and look, it's as simple as saying, okay, well, look, I'm going to pay a premium for that one on what this property's value is. Right now, my 3-bedder at 449, the median price for 3-bedders was actually still 550. Right, so I knew it still had that margin that it could creep up just purely to meet the rest of the market. And the reason why it was a little bit cheap was the smaller block, but. People don't live the same way as they used to. We're not kicking the football in the backyard. Like we've got parks nearby. We've, we live in Melbourne, and the crime around here, no one's kicking the ball in the street anyway. So it's one of those things that we're actually living very differently, and because of that, our attitude towards the way that we buy and the products that we buy change, and that's why there's these cohorts of people that are choosing fixed dwellings. So unit markets, 60% of Australia, units are outperforming houses, and that's madness for a lot of us who have worked in the industry for a long time to believe. We're like, well, I don't believe that. If you want growth, you buy land, but it's changing, and it's not just anecdotal. It is data driven. 60% of unit markets around Australia are beating houses.
And is it in certain pockets of Australia? Is that Australia
Mainly capital cities, but I can tell you now, if you go into large regional hubs as well, and when I say units, don't think high rise. I mean, some markets high rise is going well too, but that's probably when it's coming off a really low base. It's probably gone, hey, it was up here. We've had shocking years. So Melbourne City right here, Melbourne City units have really plummeted, but now it's one of the best performing markets in the Melbourne greater region. And it's because they're coming off a low base. And if you compare the unit price to the house price, there's such a disparity that's dragging them up. But when I quickly go back to where the fact that we're living differently, I grew up in country Victoria on farms and things like that, or even when I wasn't on a farm, on 4-bedroom homes on land, and things have changed now where I moved down to Melbourne and I hated the 1-bedroom apartment. Now I'm back in a house in Melbourne, but I would prefer to be back in the apartments because it had that great lifestyle. It was amazing amenities, all those types of things. Yeah. So, people think about units and why don't they grow? Oh, they've got a smaller land component, they've got the body corporate and all those types of things. I'm not suggesting for a moment to discredit that. But what people aren't understanding is real estate markets are cyclical, and the only inevitable thing is change. And what's changing is that house prices have gone like that, and the unit prices are getting dragged up by the disparity and the fact that we're all living differently. There's cohorts of people like downsizers, lifestyle buyers, immigration, so people that are moving from overseas quite often used to living in fixed dwellings, high rises and things. So they want to live that way.
And in a lot of respects as well, we're actually seeing unit prices also outpace house prices as well.
Outpace both in growth and in rent.
Yes, absolutely. So it's a very strong indicator in terms of a market. I think a market that a lot of people have been neglecting for a very long time, just because of some preconceived understandings in terms of the role that units play in the housing market. And it was a very real thing. We see it with our toothpaste. We see it with our favorite chocolate bars. That is shrinkflation. Mate. And it's the property market is certainly not void of that.
No, not at all. I mean, developers don't like putting their price up, even in land, right? So they just cut the size of the blocks and keep the price the same size, and that's how they get their margins. So that's absolutely going on. There's no doubt about it. But I'll give you another example. So when I talk about units, it's not necessarily about the inner city stuff either. In regions like Toowoomba's a market that I love, right? It's had a lot of growth, and there's a couple of property clocks getting around Australia that have had it at the top for 12 months. It's peak of market for 12 months. It's still got room to grow. And I'll tell you, the reason it's got room to grow is all of the reason that people have been buying there and the reason it's growing is because of all of this infrastructure that hasn't come yet.
Yeah.
So for 5 years, it's had bumpy years, but it's still got the inland rail. It's got the Olympic Games to come, which will definitely have improvements there, equestrian and all sorts of stuff going in. Got a $1.3 billion hospital getting built there. There's all of these things. And yes, it's had growth, but the incomes can still support further. But it's a market where if I want to buy into a house, quite often it's either going to be an older home, it's going to need some renovations, or it's got to a point where the rental yield won't support in a high interest rate environment for everybody. So what do? I look at unit markets there. I have less competition and I can buy into a unit where I get $1 per thousand rent. Which is, if I spend $500, I'll get $500 a week. If I spend $600, I get $600 a week.
Yep.
Hard to do that on the houses now, but I can definitely do it on unit. And I always look for something that's, low density, low body corp. People are scared of body corp. Right? And, rightly so in a lot of places.
Yeah.
But in a lot of townhouses or, small complexes, it's basically just your building insurance, but you've got it as a shared strata.
Right.
So as long as you understand the body corp and it's not exorbitant, and there's not like big increases happening to it all the time, and you obviously do the due diligence, not just on your contract, but also the body corporate minutes, it's a safe play.
Yeah.
No, absolutely. Definitely.
Another question for you, Tim. I'd love to hear your perspective on this one. So we spoke about Playford, had like 5 consecutive years of double-digit growth, which is outstanding. Toowoomba as well. A question that's always on my mind is, when is it the right time to tap out of these markets?
It's a very good question. So even Terry will say this. He always, I think he said it at an event the other day that you and I were both at. He said, one thing I learned in real estate is never ever sell.
Yeah, that's right.
And it's where there's not many things that him and I disagree on. I'm of the opinion that you can't be emotional about real estate. You can't be emotional about investments. Okay. Right. And the key is, if you see that this property is not performing and it's taking money out of your pocket, why would you not sell? I don't care if it's going to be worth more in 20 years' time.
Yeah.
The fact, if I've got debt associated with a property and it's not performing, yes, there might be some consequences in the sale in terms of cost to sell and the cost to rebuy. But if I can take that debt that's weighing me down there and reinvest that elsewhere, it's going to outperform that 20-year that will eventually turn. So we differ a little bit on that. But in answer to your question, how do you know when the time to sell? The same thing, a formula applies with how I picked the Blakeview market to take off. It's the exact opposite when it comes to selling. When I can see a market is reached a peak, that might be the good time to sell. I'm not suggesting that you become a speculator in real estate like you do with shares, buy low, sell high. What I'm saying is, in real estate terms, it's it's obviously an expensive exercise to do that. But if you are thinking that the property's got to a point and it's not going to grow for a long time and it suits your lifestyle and goals, it could be worth time to sell. And that's because you've seen sales activity is slowed. The 12-month growth market, every month when they release that, like Perth was at 15%, today it's about 5 or 6%. Every month when they release the data, it's dropping, which signals we've reached a peak. Yes. That could be a good time to sell, but never sell just for the sake of selling.
Yeah.
Exactly. You sell because it's helping you. I've done this before. A good example of when to sell. It was just after COVID. Geelong had a really big spike. I forget the years. It had 5 or 6 years of really strong growth. But then after COVID, it had sort of reached a peak where it had sort of slowed down. And it was a market that I had a lot of customers that had done very well in as investors over the last sort of 5 or 6 years. And at that time, I said to a lot of them, look, you're going to get a different sort of conversation out of me on this call, but I know you've still got some debt on your own home. I don't think that we're going to see any growth in the Geelong market for the next couple of years. In fact, I think it might come backwards. And no one wants to hear their buyer's agent telling you that. But ultimately, I'm not saying that my decision to buy there was bad. It wasn't. It's done what it's meant to do. But all markets go through cycles. It'll slow down and all those types of things. So I said, how would you feel about being debt-free at home? I love that. Let's sell. We've reached a peak. Now's the time to sell. We wipe off the debt at home. That gives us free bad debt. And now all of a sudden we can do an equity release with investor debt, and we can actually go into a market that's now rising.
Yeah.
So that's the way that I think of cycles. And as I say, I'm not disagreeing with Terry. There's the old saying, you don't try to time the market, it's time in market. Yeah. Okay. But if you can do both, you'll do very well.
I think an important note is here, it's if I spend $1 here and $1 there, where's going to be my best bang for buck?
Yeah.
It's all about return on investment. And if, for instance, you've bought in the Perth market a few years ago, and let's just say you've grown your equity by $200,000 and now it is a good time to sell because you don't think that is going to continue growing and there are other markets that are going to grow and far outpace the Perth market, then that's a great time to sell and reinvest your money to then earn more, because you've only got a limited amount of money that you're earning. And that's where the issue lies. When you
the only thing I'd challenge on that is that the 200,000 is probably not going to be 200,000 by the time you pay capital gain and all of your other expenses. So it need to be significant.
It does
to outweigh those cost of selling.
Well, exactly right.
And rebuying, I should say.
Well, you got to make sure that your cash outlay per year plus the capital growth in the other suburb that you're going to invest in is going to far outpace the costings that you will incur from that 200K. Absolutely.
Worth noting as well, when I've referred a couple of times to Perth being peak of market, that just because we've seen sales volumes completely fall off a hill and that the 12-month growth come back, that doesn't mean sell. And it doesn't mean you bought something bad 2 years ago. It means that it's had huge growth and it can't sustain that with the current incomes. So it will go like that for a bit. It won't go like that. I really don't think that it'll fall off a cliff like it's done previously, because it's not a boom and bust market anymore. It's a lot more diverse, but it will have a plateau effect and then it'll grow again. So you've got to weigh that up. Don't sell if you think that that's going to happen.
Yeah.
And one thing that we see as well with a lot of these markets is that they're very flexible and going upwards, but in terms of the way down, it's very sticky. And that also gives an opportunity or a bit of a breather in terms of reassessing in terms of whether that market makes sense.
Yeah.
The other thing as well is, and this is something that we discuss a lot, is there's an eject seat, right? It could be either reaching a certain amount of growth for a given property. It could also be, as you rightfully mentioned, if that property or holding on to it is starting to affect your lifestyle, then it's probably a time to reconsider. So it's just understanding what those levers are and when you need to pull them, and also working with someone who truly understands and has seen many different instances and cases and can recommend.
Jad, that's the key. I think that's the
exactly.
key. How many people do you think of just gone, this is killing me, I'm sick of paying out all this money, and then they sell, and then what's the property market do in that location after they sell?
Exactly right.
Go, if I just held on for another 12 months, Now, when the way to avoid that happening is obviously speak to people that understand these market cycles, can give you an indication, and maybe don't just speak to one, speak to a few.
Yeah.
But what you need to understand is where that market is today. What's it going to cost me to hold until that next growth market comes off? And if it means that you've got to maybe pull out some equity from existing home to sort of compensate for that, but you know that the upside's going to be there, it's worth holding.
I think it's also important to know when you are, for instance, dealing with a buyer's agent, you need to have someone that's going to manage your portfolio. That's what we ultimately do. Look at the portfolio, revisit it, see if there are other levers that you can pull. So then that way you can either do an equity release, or if the option is to sell because of your lifestyle changes and your cash flow, then you can also sell. But it's important to always have a look, have a bit of a health check essentially on your portfolio. Which a lot of people don't do. A lot of people just sort of sit there, they wait, they feel like they're stuck in the gears, but there is an opportunity to revisit it. And there always is opportunity to sort of see where else is outperforming so that you can do something there also.
Absolutely.
There was a question that Omar and I always talk about, and that is a lot of people treat property investment like a hobby. And it's in the stats, right? Like, what is the stat around how many people own one investment property?
ABS stats say 72% own one.
Yeah, that's right. That's right. So, however, I think more people need to treat it like a business. And so one of the things that we explore is, okay, especially with some of the people that we're having conversations with, it's how is their property portfolio geared towards future growth? And a lot of the time it's just, kind of finger in the air. Well, I'm just going to choose this property because it's got really high capital growth, but it's pegged to one industry, which is, say, mining as an example. So one of the things that we try to educate our clients on is, how do you think of property investment more like a business? Because it truly is. Speaking to the accountants, speaking to a broker, and having trusted advisors around you to help, and let's not forget about the buyer's agents as well, having those trusted advisors around you to better inform you. The open question is, when or how do you identify someone who's treating property investment like a hobby farm? What are some of those warning signs that you would see?
All right. Well, I would say I agree with you that a lot of people do treat it as a hobby. The way I'd probably frame my answer would be to say, if you had $500,000 to go into a business, would you do that without seeking advice from a mortgage broker? Would you go and seek advice from a business consultant or somebody who's done it before, or build a team around you that can help you make that business successful? Absolutely not. Why would you treat property investment any different? And the thing is, I think a lot of people look at the cost to seek professional help And they see that as the roadblock, but it's such a false economy. As an example, the average price for a buyer's agent might be 15 to 20K, right? And I know there's some either side of that, but let's say for argument's sake, it's 15,000. If you go and buy a property and you overpay 15,000 and you've made a mistake, hasn't it just paid for itself? If the buyer's agent finds your property under market of 15,000, haven't they paid for themselves? If they can find you a property that outperforms the one that you would have bought by 15,000 in 12 months, haven't they paid for themselves?
Very good.
So, I mean, think about that when you go and look around all of the other professional things that could work in your favor. Look at superannuation. How many times has that changed? I can't keep up with it. That's why I pay professionals to do that for me.
Yeah.
Accounting. I mean, there's no way I would get the sort of tax returns I would if I tried to do this myself.
Yeah.
So why would you treat real estate or property investment any different to you would at any other part? Health is another great example. I'm not going to self-diagnose myself. I'm going to go and see a professional.
Many do.
Yeah, exactly. Right? So why would you treat something
Probably,
I don't want to say so expensive, something that's so high value?
Yeah.
And let's think about the consequences of getting it wrong. Real estate's a bloody expensive exercise to get wrong, and it's not as simple as buying shares and all of a sudden, oh God, that's dumped. I need my money back. Let's sell out at a loss. You might not have that opportunity. Go and try to sell that in a market that's flooded. Go and try to sell your piece of real estate when they can't get tenants.
Yeah.
And it's or what even worse when the bank comes and says, hey, you're not paying your mortgage because you don't have tenants.
Yeah.
We're gonna have to repossess your home.
Yeah.
And they won't come after the investment property. They'll probably come after your home because it's the one with equity.
Yeah.
So we're not trying to bag out real estate here, but it is one of those expenses.
Absolutely.
that
And I think
you cannot get wrong.
And I think people don't understand the risks as well.
Yeah.
If you default on your payments, your credit score decreases. If your credit score decreases, good luck getting a credit card or any other type of lending. So there is a lot of risk
Flow-on
factors
effects.
involved. And it's such a large purchase that you should absolutely go and talk to the professionals. At the end of the day, we're only here to serve you guys and make sure that we've done a good job. So there is a lot of value in what we're doing. I mean, like you just said it, everyone needs a coach, whether you're a boxing professional
100%.
or you're a health professional or someone that is looking to achieve something in their life. Even a coach needs a coach.
Yeah.
So
That's
I
a good way to
mean,
put it.
you know what I mean? At the end of the day, you need someone to be able to.
Terry Wright has been doing this for 40 years.
Yeah.
Does not lack the knowledge to go out and find a good investment property. Every time he buys one, he uses a buyer's agent.
There you
Oh,
go.
really? Okay.
Why?
Yeah.
And I might happen to be that buyer. but why? Why does he do that? When he doesn't lack the experience or the knowledge.
No, of
the reason he
course.
does it is because he wants a second set of eyes to challenge it. He wants, and the other thing is time poor, right?
Yeah.
So he takes his time that's too precious, and he makes me do it. No, I mean, in general, it's one of those things that you most people they make their money 9 to 5,
Yeah.
and Monday to Friday. And if they and any time outside of that, they probably want to be with family. If you're taking on this hobby or this new business, which should be the way that you treat your real estate, why would you want to do that in the time that you could be earning money doing what you know best?
Yes.
When somebody else who knows that this is what they do for a living could be doing that for you and actually saving you that money plus a hell of a lot more or making you a hell of a lot more in the long run.
A funny story. We had a client who approached us last year. He wanted to play in far north Queensland. We've done a lot of the interim conversation around, exactly what he was looking for, etc. And he's done the usual thing where it's like, I'm actually, on the back of some of the conversations we had, he shared some properties with us and we were just about to press go, but, for whatever reason, he got cold feet, which is fine. He just recently reached out to us after the market had shifted in the last year or so. And, open discussion, he's looking to sign up, but he was like, look, Jad, at the time, I just couldn't rationalize spending that amount of money. But fast forward 12 months on, and these markets have moved by 150K at least. He's basically kicking himself in the ass, going, what have I done to myself?
Yeah.
And so now, unfortunately, I had to just resurface these regions. And basically the direction here is we're no longer playing there. The market's moved. We've tapped out. Now you're actually having to, based on your budget, play in this range.
Not to mention the interest rates have changed a hell of a lot too, so you can borrow less.
Yeah.
Correct. So yeah, he was kicking himself, but look, that's what it is.
But I got one which you just reminded me of. So a lot of the time they think about buyer's agents or somebody with experience in real estate or finance as just the product. But it's the actual creative thinking of it all as well.
Yeah.
I'll give you two examples. I had a lady last year who came to me who had never had money, right? She was a single mother growing up in Brunswick, and she's got a daughter with special needs. She got 800,000 from her father who passed away in New Zealand. And she didn't want to leave the special school that her daughter was in. And she's like, what am I going to buy here for 800K? And is it going to grow and all those types of things? And thankfully I got introduced to her. And I said, look, I know you've got 800,000, but do you want to part with your 800,000? Like if you've said to me that you haven't had this money and you're worried that you're going to waste it, why don't we take on a mortgage? And she said, why would I do that if I've got 800 grand? I said, because we can take on the bank's money. And we bought a property. It was only worth 450,000, but we bought this beautiful house with in Mount Gambier in South Australia. It's a corner block which we can subdivide in the future, right? But for now, it's small, good 5% rental yield, really easy property manage. We took on the debt for that at 80%, but then we parked the cash in the offset account. So she's still got access to all of the money. She's not paying any interest on it. And she goes, I would have just wasted that. And if it had gone backwards, I would have no access to it. But I mean, those types of little things that you can do.
Probably earning money now.
Yeah, well, that's right. And now she's got unencumbered rent coming in, right? So there's things like that. The other one that I'll tell you about, which is a bit of a feel-good story for me, but it was a testimonial that I got about 5 years after meeting this person. And the reason it's a feel-good testimonial is because I never made $1 off them. And that to me is actually equally as important, because I feel good because I helped somebody who I didn't even make any money off. And what happened was years ago, I was doing in-home consulting. So I was going out and meeting customers at their home, and it was in Wangaratta. And I met this couple on their farm, and they said to me, Tim, as soon as I walked in the door, they said, Tim, you're not going to be able to help us. Okay, why am I here? They said, look, what we want to do is we want to buy the farm next door. But, because we're farmers, we don't show much income. And that's quite common that, self-employed people in general, all the time, their accountant makes it look like they're not making a lot of money, which is great. You're not paying a lot of tax, but it also means it's hard to go back to the bank and say, can I have some money? So anyway, they said, we've had 6 of you guys out here and no one can help us. I said, okay, well, I'm not sure why I'm here. But I said, tell me about the situation. And they said, look, we want to buy the farm next door. I said, okay, tell me about the owners of the farm next door. And they said, look, they're old. They want to get off the land. They actually have a place in town in Wangaratta and they want to move to that. I said, okay, do you think they need the money up front, or do you think they'd be happy to get it paid off over time? And I said, I don't know, we could ask. And I said, if you take on that farm, I'm assuming your head count on your cattle is going to go up. It's going to increase revenue. Why don't you put something forward to them that they get to get off the land? You take it on as an option, but you're paying it off over the next 10 years, and you're using cash through the business to actually pay them off. It gets them off the land, you get the property, away we go. Anyway, I left it at that. They said, we'll try. And I said, make sure you seek legal on that and everything. You can't just go and write it on a napkin like growing up in the country we did in the past. So anyway, so I left it at that. 5 years later, I get this email from them, and they said, Tim, you saved us $1 million. And it was literally what the email said. And I was like, why? And I said, we worked out, because they accepted it and we were able to buy the land. If we had gone and taken that loan from a normal lender, we would have paid it off over 30 years, and we worked out would have cost us about $1 million in interest over the time. I can't remember the exact figures. I remember they said $1 million, but I can't remember what they bought it for and what they paid it off. But that's just creative finance, right? And it was because the lesson in this is it's not always about the price, not always about the terms. It's about understanding what the other person's motivation is and coming together to find a deal.
I love that. That's powerful. Did they at least get you a present? Or
I can't remember. They let me use it as a testimonial.
Well, that works out well. There's definitely a lot of good feel-good stories. I mean, in our industry, we're making people wealth, right? There are so many situations for people that we have changed, and there's so much financial freedom we've been able to attain for people. And there's so many good things that we're going to be able to achieve in the future. I think it's just making sure that we've got the right processes in our business to be able to continuously offer them the right results, right? And I think I wanted to ask a question beforehand, and it was, there are so many buyer's agents now, right? There are, buyer's agents that have been around for the last 10 years, and there are buyer's agents that have been around for the last 10 days. And so, I mean, there's obviously such a big price discrepancy for the clients out there that are looking for homes, and they're getting signed up with these people that are charging, let's just say $7,000, $10,000, lesser than what the average is, or whatever it looks like. I mean, how does the quality differ? If you've seen in the industry, you've obviously been in it for quite some time. How does it differ with someone that knows how to run their business and knows how to actually build wealth in comparison to someone who's just sort of done this and, this is a side gig for them and they're trying to build a business? Yeah.
Well, we talked about red flags before. If somebody's dirt cheap with any type of service, it's a red flag most of the time. So the first thing I would do, and this doesn't even come down to price all the time, anybody that you want to work with in this industry, I was out there to find a mortgage broker, financial planner, accountant, or anything like that. Seek referrals. Like ask people that have used them in the past, right? What's their track record? Do they invest in real estate? Do they own any real estate? Right? How long have they been doing this for? And those questions are still going to tell you whether or not you're better off paying the person who's got the experience and pay for peanuts, and you typically get. You know what I mean? Like
That's how the saying goes, anyways. No, 100%.
It's just not worth. As I say, it's a false economy. If you could get the right, and think about it, the service that a buyer's agent offers shouldn't just be about the search and you negotiate. It should be about all of the other things that you do as well. It is about making sure that you've got a qualified building and pest inspector reviewing that that report, helping them with property management and negotiating better deals, seeking a 6-month review to say, how's everything going? Here's my number. If you have a rental review, give me a call. I'm there to help you throughout this, and that's how you get repeat business.
Absolutely.
Someone who's charging $7,000 is transactional. They're going to go, and I can almost promise you, if they're any bit successful, they won't be $7,000 for long, because I realise that they can't run a business like that.
Absolutely.
Yeah,
absolutely.
No, definitely.
Yeah.
Something that we're also doing from the very beginning is strategically look at their portfolio, what's going to help them get there. We use that using the Game Plans tool. Love the tool. They do an awesome job.
Shout out to Game Plans.
Yeah. So they do a great job in the sense that they articulate what the long-term play could look like. And I think that's key, because if going back to the commercial analytics space, if you don't have a focus in terms of what you want to achieve, especially into the future, then the likeliness of you hitting it is overwhelmingly low.
Yeah.
So it's important to have that articulation, and that's really, really helped our clients in terms of basically understand what does their property portfolio need to look like, how does their structure need to sit, and that's why we connect them with also trusted accountants that. I think people always fixate on accountants as being tax mitigation or lower your tax, like you rightfully mentioned with that farm example. It's not about that. It's more around having an accountant as a strategic partner, which
it's about structure, entity, all those types of things.
Absolutely.
Right.
Absolutely.
And that should all be done from the get-go.
Yeah, it's
before you
very
buy
expensive
your property.
to change later.
Yeah, absolutely. You got to pay stamp duties again if you want to change entities, and there are so many hurdles to go through if you've set it up in the wrong way, and it limits the amount of properties that you can buy.
Yeah.
I mean,
the other thing on what you're talking about around the game plans, the structure and things is people forget why they're buying real estate. Might be a really strange thing to say, but you say, why are you buying real estate? Oh, I want to grow my wealth. I want to make more money. I want to all these things. But a lot of the time, even if your property is growing, it hasn't necessarily made you money.
That's right.
You have to think about the exit plan. And I think a lot of people go into it with that, I want to buy more real estate and I want to grow my portfolio and I want to do this and I want to do that. And I can't tell you how many times I had a strategy session with a customer. They say, I want 10 properties in 10 years. And I go, do they have to be 10 good properties? Because you could probably get 10 properties, but I'd probably prefer to have 5 headaches that are really good headaches than 10 lots of headaches.
Exactly.
Because it's not as simple. Like, let's face it, right now, if I own Tesla shares, nobody tells me how to use them. No one tells me whether I can sell and whether I can hold and how I'm going to treat the Tesla shares. But on any real estate transaction that I have or anything that I manage with a tenant in it, I'm losing control of those assets. I'm not, again, trying to smash real estate because I love real estate, but it's something that people need to understand is that there's things that you need to consider when owning an asset like real estate, whether it's compliance, whether it's the rental legislation, whether it's the CGT, whether it's the changes to negative gearing that could be coming into effect.
Yeah.
So much to consider, but yet somebody might want to go out and treat this like a hobby. And if you don't have the right answers and you're not prepared for change, that's where it can catch you out.
Isn't that funny, right? Like as an industry, it's very rigid to buy in, to sell out, to structure your accounts, to unravel those accounts. So that's why it overwhelmingly pays to measure twice, measure thrice, and then cut once.
Yeah.
But people, unfortunately, tend to miss that component.
Also there's something that's very important. A lot of people look at property as sunshine and rainbows, but what they don't understand is there are holding costs throughout the year. And although your property is gaining in value, if you're not looking at it from purely a numbers perspective, as knowing your numbers and understanding where your cash flow lies, then you can go back very quickly and you can be at a loss no matter if your property doubles in value in the next 10 years. If your cash outlay is more than what that is, you've got to make sure that you're doing everything right, understanding your own assessment on your cash flow outlay per year to then understand, okay, if I do sell this property or if I continue to hold this property or pay it off, it is going to make me a profit.
Yeah.
You know, people aren't running it like a business, and that's where they're falling short. Know your numbers is what we always say to our clients. Know your numbers. We will do the numbers for you, but know your own numbers, you know, because there are going to be things that pop up.
I think right now, know your numbers is really important because people are looking at opportunities in market for growth, Victoria being one. So they say, God, Melbourne's so affordable. And they're not wrong. It's cheaper than Adelaide, Perth, and Brisbane by median dwelling now, which is hard to believe, right?
Yeah, I know, right?
So you go, okay,
I would have thought.
Melbourne's the best place to buy.
Seriously.
So then you start to look at it and you go, let's look at the numbers.
Yeah.
It's going to cost you more on stamp duty. Rental yields are pretty average. Land tax kicks in at 50,000. Across the border in New South Wales, it doesn't kick into $1 million.
Yeah.
We did an analysis last year where we looked at if you bought the median priced house in Sydney, which is about 1.3, and you got the median price rent, and then you did the exact same thing in Melbourne, which was about 800,000, you got the median price rent in Melbourne, how much would you lose on an 80% LVR loan? How much would you lose on that property in Sydney, year one, taking into account your entry costs and things like that? You'd lose about $15,000, meaning it's negatively geared. Go and do the exact same thing where you bought a property that was $500,000 cheaper down here in Melbourne, you'd lose $25,000.
Wow.
Get out of town.
No.
Oh,
so this is why I say know your numbers, because people look at the upside, they look at, growth. But I mean, if you're losing $25,000 year one, right, that you're starting behind the eight ball unless you bought very well. And look, don't get me wrong, Melbourne has that in spades at the moment too. When you think about what do I want to achieve out of my piece of real estate in the next couple of years, everyone wants that quick hit of growth, right? But Melbourne's offering that in reverse in a lot of locations where you can buy that growth below market value, so you can buy better here when you're going into those markets that are already rising and quite competitive, hard to buy under market value.
No, absolutely. Definitely. It's knowing your numbers, so then that way you can make an educated decision. You're not just guesstimating everything. And all in all, property is for the long haul. You're not going to sell your property in a year, nor is it going to be 2, 3, even 5, really. You're going to hold onto your property for as long as you can up until that cycle starts to sort of cool off, and then you're going to make your next best decision. So you need to understand what that longevity looks like.
Absolutely.
Got a question for you as well now, Tim. AI and where that sits in the property space. What we're finding a lot at the moment is we'll run strategy workshops with our clients. They're also running AI in the background. And I think it's playing more of a foothold in terms of the way we operate as a society as well. Happy days, I think it's great. I see it as a bit of an assistant. Some people see it as a bit of a, it's going to take our jobs, probably as buyer's agents, but more widely, I think there is going to be a bit of a shift in the market. Now, Hotspotting, though, you won the AI Australia Innovator of the Year, which is an outstanding feat. Could you tell us about what Hotspotting is doing in that regard and how that's changing the market as well?
Yeah, okay. So the first thing I'd say is I've got to tell you a quick story about AI. A customer of ours at Hotspotting, who I did a strategy session with about 12 months ago, and basically he wanted to get back in the market, and he also wanted to pay off his home. And he'd done really well buying through our Hotspotting reports. He'd bought 4 or 5 properties over the last sort of 10 years, and a lot of them had sort of done quite well. And we were talking earlier in this session about when to sell. For him, it was a really important thing that he paid off his mortgage. And I said to him, I think you're ready to tap out on some of these. Like they're actually at the peak of the market. I don't think you're going to see a lot of growth in those over the next couple of years. You've had some really strong growth. And if it's important to you to pay off your mortgage, let's sell a couple. So we did that, and he sold out and he's debt-free and he's wrapped. But he said, Tim, what do I do now? Because he's obviously got all this equity and he wants to invest again. And that was all part of the strategy. We sell down, wipe off debt, redo an equity release and start again. And he said, he copy and pasted it. He said, I asked ChatGPT, where would Hotspotting tell me to, he had a $4 million borrowing capacity now. How would I split up my borrowing capacity and where would Hotspotting recommend? And he copy and pasted it to me. And I felt so good.
Yeah?
Yeah, because it had no idea.
Wow.
And
God.
I responded to him and I said, I'm so glad that you've just sent me that because I know my job's safe. Right? That was a shocking thing. And, I don't think it's because ChatGPT's looked at our website. I didn't even know half of these locations. It's bizarre.
Yeah.
Right? So anyway, the point is that ChatGPT, it's, garbage in, garbage out, right? People talk about prompting and all that type of stuff, and there's a merit to using ChatGPT really well.
Absolutely.
But it can only give you insights on the data that it's fed.
Exactly.
You don't know where it's coming from half the time. How do you trust that?
Yeah.
right? Now, on the front of AI award that we won, we made a conscious decision a couple of years ago to really take on AI and run with it, because I knew that if we were early adopters of it, we could get ahead of the market, and we have. There's no doubt about it, and the award says that. But how we use it, I think, surprises people. We don't use it to make any of our decisions at all. So what we did is we built a data warehouse, and we use machine learning to actually turn our price predictor index and a lot of other things into a formula that we can do in about 2 hours, which used to take us 9 weeks.
Oh, wow.
The operational efficiencies that AI gives us is remarkable.
Yes.
But what it does is it just gets rid of the noise. So here's some stats for you. There's about 33,000 property markets in Australia, about 15,000 suburbs, or a little over, and then you've got unit markets and house markets. Now, within that, there's I think we worked out, if you said, only show me markets that have got 25 sales in the last 12 months, right, which means that anything below that, it gets rid of. We're only left with 4,500 suburbs or markets in Australia, which means we've now got a manageable size. From there, we actually identify rising markets, declining markets, and everything. And then we use AI to run it through our empirical formula based on population size, minimum vacancy, as in we want a low vacancy rate, rental yields, all these types of things. So it gives us a manageable amount of data that we can then analyze as humans. And that's how we speed up the process. We've also got other things like, a chatbot that's powered by our reports, and it's done our property course and all that people can go to and get instant answers really quickly. But the answer to your question is that AI is not taking our jobs anytime soon. I'm pretty happy about that.
Yeah, no, absolutely.
But what it does do is it allows me to spend time on more value-adding things.
Yeah. No, I think in terms of operational efficiency, AI is a must. And if you're not integrating AI into your business now, you're
mad.
You're getting left behind. And there are so many things in terms of, for small business anyways, I mean, whether it's HR costs, operational efficiencies, automations, you need to know how to integrate it though, which means that you need to know which problems you're trying to solve. Yeah. Because if you don't know the why, you will never be able to solve anything. And this is the thing about AI, right? You can prompt. Exactly right. You can put any prompt into AI to find out, where the hotspots are and, whether or not people are buying, and is there going to be even any capital growth? But at the end of the day, a lot of the intricacies with AI doesn't take into consideration the negotiation, doesn't take into consideration, is that data in real time? Doesn't take into consideration a lot of things that unfortunately miss the mark, and you can potentially make the wrong decision. Yeah. So wouldn't you rather someone that's done it, has the experience with hundreds of negotiations or buying property under their belt? I mean, it's a no-brainer, really.
One other thing that I'd add to that is that if you were to go and ask the internet or go and ask ChatGPT the best places to buy, it's most likely going to source that data from real estate websites. And the thing that I'm really proud about Hotspotting is that where we differentiate from most real estate analysts is that we don't look at real estate data in isolation, and we don't look at only as a rear view mirror, like what's happened. We also look at economic data, demographic data, infrastructure, population trends. That's what gives us forward-looking insights. Yeah. Right? The data that you're getting from ChatGPT says, well, this market's on the move, right? And it's 3-month growth, that's it, it's that. And even sales volumes, we'll give you an example. So I mentioned sales volumes can be a precursor to growth. So we see rising sales activity and you go, geez, that's spiked. Why? You might find out that that particular suburb had 3 large developments that all settled at the same time. Without a human actually identifying why that happened, it could quite easily be led up the garden path. No, absolutely. So, we've got 60 years of experience in hotspotting with real estate journalists, like our people who write our reports and everything like that, have been working in real estate field as journalists and licensed agents as well, like as in background in real estate. So, they know what to look for, because data in real estate is notoriously dirty, right? The perception of what it's trying to tell you and what it might actually be can be very, very different.
Absolutely.
In terms of property and the market, is the market going to crash? And are we going to see a correction in the market? Because a lot of people are like, they're doomsdayers, right? Everyone thinks that, obviously there's going to be so many things that are going to happen around the world, whether it's World War III, nuclear bombs being dropped on everyone, the property market crashing, the US dollar crashing. Everyone's a doomsdayer these days because everyone's seeing online all of these different hypotheticals. In terms of the Australian property market, though, keeping it relevant to our industry, what do you see in terms of the next 10 years in property, and what does that mean for investors?
So I would look at it like this, and I'm not going to pretend to have a crystal ball, right? But what I would say is this. When COVID hit, the headlines were just flooded with we're going to have 20% drops in real estate. Some said 30%. What actually happened is we had a 20% growth, which means they were 40 to 50% wrong. Right? These guys are always wrong, the bank economists. Then when interest rates started to rise, they said the same thing. The property market here in Australia is going to crash. Why didn't it happen? The single word is supply. We just don't have enough houses. Right now, our population's grown by about 4 million people in the last 10 years. We have less properties now for sale and for rent than we did 10 years ago, with the population growing at the rate that it has been. Housing is a necessity, right? So wars breaking out overseas, and hopefully they stay overseas, we're still going to need a house to live in. So what's happening is we've sort of, if anything, we've reached a peak certainly in rental markets where the rent might not be able to go any further. But what happens is that the household formation changes. We start living differently. We have more people under the same amount of houses. But realistically, we're not under mortgage default. We're not seeing any of those types of pressures and unemployment that would suggest that we're going to see that cool at all. If anything, I would say that a lot of markets will do the opposite. And again, if we talk about media headlines, end of the financial year, depending if you're following PropTrack or Cotality, the national market averaged about 5 or 6%. And when we did that analysis the other day, where we wiped out any suburb or market that had less than 25 sales in a 12-month period, we were left with 4,500 suburbs. Of the 4,500 suburbs, 1,700 of them had above 10% growth last year. 600 of them were in Queensland. Over 400 of them had over 20% capital growth. But the media will focus on those little small bites. So my point to answer your question is, we're not going to see, markets across Australia. And this is the thing, we have thousands of property markets, all are reacting very, very differently. Yeah. So the key is you just need to know where, more so than what. And
don't follow the headlines.
Don't follow the headlines.
The news is relatively following, the negatives.
Yeah, of course, that sells.
That's exactly right, and that's what sells. Yeah. Even when I'm making my TikTok videos, the most viewed content are the ones where I'm like, this is the worst suburb.
Yeah. Do you know what's really funny is you talk about that. Anytime we put out, our YouTube clips and things like that, even though that Perth has passed the peak, if we mention Perth in any of our videos or headlines, that's the one that gets viewed the most. And I've worked out the reason being is so many people bought there, they want to know what's happening now. But Perth still seems to be the keyword that really gets the most attention on our YouTube and ticker and all those types of things.
Is there a canary in the coal mine that indicates, well, you know what, those doomsdayers were right and we should probably start thinking about, well, where Australian, and I know there was a bit of conversation around not calling the Australian property market as one big umbrella because there are markets within markets and that's overwhelmingly misleading. But is there some sort of indicator that'll let us know that, hey, things are looking a little bit dire in the property space. We should probably start focusing on, well, what we do next.
So I'll answer it a little bit differently and I'll look at it and say, look at other markets like the share market, right? So if we have a crash in the share market, on paper our value goes down. We didn't make a loss. We make a loss if we sell. So if we've got real estate that we're holding, and the reason we bought in this location is we think that we're buying for the long term, as long as our tenants continue to pay, why would I sell? Right? Now, I don't think that it's going to happen where we're going to see this crash anyway. But rental markets, I mean, vacancy rates across the country are 1%, like as a national average. There's a couple of pockets that are a little bit higher than that, but most of the time when they're higher, it's like a new estate that comes in, like there's places like Melton that are 7% right now. Yep. That'll get swallowed up and it'll get back to where we were. Yeah. And the reason I raise that point is, we've got the luxury that even if on paper our property prices dropped, we've still got the rental income coming in. Right, and if you follow anything in, if you put any merit to what the speculation around interest rates is going to be, with interest rates coming down, hopefully that means that our holding costs would actually get better. Yeah. The cost of, the value of our properties dropping is not the end of the world. No one buys real estate and expects it to go like that for 20 years, like just straight line. I wish it did. But what it's going to do is it's going to probably average 8-10% or something over the next 10 years, and we're happy with that. The market's dropping like that, and no reason for alarm. But I think people, it's a hard thing, mindset. But the thing is, no one's thinking about that in a super every day, and it's happening every day of the week.
Yeah, exactly correct. Right. Exactly right. There are corrections every day all around us, whether that's with anything to do with petrol prices, groceries.
We have an emotional connection to real estate in this country.
We do.
Right, where even if it is an investment, we want to look at what's the valuation and all that type of thing. Yeah. No one's checking their superannuation every day.
No, absolutely not. Absolutely not. No, I think that's pretty much it. I think we're 7 minutes out of 4, but thank you very much for coming on board, Tim. Really, really appreciate it. We had a fantastic conversation, and I think that there's definitely a lot of value for all our viewers, and hopefully all power to you, mate. Keep investing and keep helping other people invest.
That's all right. Appreciate it. Let's do it again sometime.
Thank you very much.
Thanks so much.
Tim.
Thank you.